No sé, háganlo intentar.
Okay, so let's begin. If you want to win this game, yes, this simulation round, that is going to take eight rounds. You are going to be evaluated with 6 indicators. Okay, sales revenue, EBIT, which is like a profit dimension, earnings before interest and taxes. Okay, retained earnings. This is return on capital expenditure. Okay, pretty much like you have some assets, yes, and those assets are going to produce EBIT. So with less assets to produce more EBIT is going to be better. Okay. Employee morale, this is like a human resource indicator. If you invest in your people, yes, in your talent, if you are going to put money in the budget of the employees, you are getting more of as well, no? You need to be one of the best companies of the industry in order to put happy your people, okay? And the share price. The companies that you are going to manage are in the stock market, yes? So the price of the stock, it is going to be another variable. Let's begin with information about production. Yes, you have two facilities, two factories. Yes, to produce product A and to produce product B. This is pretty much the value at the beginning of the game of each one of the factories. Yes. And for example, if you want to grow your factory, yes, you need to invest like 1 round in advance. I can make an investment in this round in order to, in the next one, have the facility bigger and be able to produce more, okay? If I want to increase my facility A, once I invest $25, next round, I can increase my production in 1 unit of A. No? Product B, it is more expensive. If I want to increase my facility in order to produce in the next round 1 unit of B, I need to pay 4 times more. Yes, $100 per 1 more unit. Okay. This is information of the initial capacity. Yes. And look that you cannot use exactly the same amount of your capacity. No, this is mainly because you are going to have problems of quality. No, not all the production that you are going to manufacture is going to be able to be sold. No, at the beginning you are going to have like 11 or 12% of production that is not going to be able to be sold. Okay. And every time, if you are not going to invest to try to build bigger facilities, anyway, you are going to have less capacity to produce. Yes, 6% per year, and this is going to be because of the effect of depreciation. No, you know that the equipment and the machine of the company are used and they are not going to last forever. So every year, every period that you are going to play is going to decrease the ability to produce in 6% because of the depreciation. This is more information about production cost drivers. In this graph, you guys have here the cost per unit. So look that at the beginning, it is higher the cost to produce product A than to produce product B. Yes, but here you have quantity produced. No, if you begin to increase the quantities of production, you are going to have economies of scale. Look at the slope of this graph. It is much bigger than the slope of this one. Yes. So the impact of economies of scale is going to be higher for product A than for product B. Yes, you don't have here too much impact when you are going to produce more units related to decrease the production cost. There is as well one learning curve, yeah. So when rounds are going to be played, there's going to be a learning curve for A, like higher than for B. Okay. Supplier credit, we are going to talk about this one in another slide. And research and development process, you guys are going to take decision of how much money are you going to invest in return and development, no? Is highly desirable for those two factories that you invest a lot of research and development, because you are going to increase the quality and many other things of your factory. Some information that I already have said. The effect of the depreciation, yes. When you are going to increase the size of your factory, you need to do it for the next round, like one round in advance, in order to be able to have more capacity, not for this round, but for the next, okay? This is like a logistic topic. Here in logistic, what do you guys need to understand? That you need to try to have available the product that your consumer is going to demand. Yes, if for example, your product is so attractive and you are going to have a lot of demand, but you don't have the quantities available, this is not going to be good for like logistics or delivery purposes, okay? I talk a little bit about research and development, yes. When you invest in research and development, you are like trying to improve like two different stages, yes. One stage is that you are putting your product more attractive, yes, like probably a better and a newer design of the packaging, for example. But as well, you are improving processes inside the manufacturing process that are going to decrease your manufacturing costs. Okay, and important that there are two effects. Yes, one effect that is going to be immediate. Yes, so if I put in this round budget for research and development, I am going to have one impact in this round, but there's a cumulative effect. If I do not interrupt the investing in research and development, and I am doing it in a constantly way, the cumulative effect is going to be present as well. Human resources. When you are investing in human resources, you are invested in selection, training, career development plan, and tools like information technology and telecommunications. Yes, so this has a positive impact. The more that you invest in human resources, the more that your employee morale is going to be higher. Yes, remember that there's one of the 6 criteria that is employee morale. Okay, and this is going to have another effect, because if you have people more motivated, your processes in marketing, in research development, and in production are going to be better as well, or more efficient. Okay. In this slide, you guys are seeing that you have the whole capacity of the manufacturing factory, but you cannot produce all the size that the factory has, no? because there's a restriction which is the usable capacity. And at the end, you are going to have some field failure rate that is going to it is not going to allow you to sell all the units that are manufactured. Yes. So when you are investing in research and development, for example, or in quality procedures, you are trying to decrease this field failure, and so you are going to get more units available for sale. Okay. This is like where the money come from at the beginning of the game. Yes. So I said that the company is in the stock market, no? So there's share capital, money that investors put into the company, which is this amount of money. You guys are going to receive the organization at round number 4. Yes, so this means that there's a previous administration that have run the company for the round 1, 2, 3, and 4. Okay, so now you guys are like the new top managers of the company. The other administration, the previous one, up to now, haven't been able to bring earnings. So you are going to receive one company that has like accumulate losses, okay, in 4 periods. And you are going to receive the company with long-term debt. The company is going to have $6,250 from a long-term debt with a bank. And there's as well one short-term debt of $450. This debt is going to needs to be paid immediately because it's a short-term debt. The long-term one is going to be paid, like, if you want, in the rounds that are going to come. This slide is very important because it's telling you information about how much is going to cost to have the debt. Okay, so let's begin talking about long-term debt. Okay, I think that you guys are going to receive the company with a debt structure that is going to be around like 69%. So you guys are going to be in this category. Okay, you are going to pay an interest rate of 6%. This equation or this like ratio is the debt divided by the equity ratio. Okay, so if you guys pick the previous slide, this is the debt. Yes, and you are going to divide these 2 numbers by this equity. Yes, so it's going to tell you that your company is more or less around 69%. Yes, so you guys are going to pay 6% of interest. Yes, if you guys are going to ask for more loan and your relation debt to equity is going to be above 80, so you are going to show to the bank that you have a higher risk. So once you have a higher risk, the bank is going to charge you a higher rate in order to try to compensate that extra risk. In the other way, if you guys are going to like repay debt, yes, and the debt to equity ratio is going to decrease, probably you are going to be only half of your debt, or half of the equity is going to represent the debt. You are going to begin to pay less interest. Okay. The short-term debt, it is the most expensive one. For short-term debt, when you go to the bank and ask for a short-term debt, the bank knows that you are in a hurry. Yes, that you have something urgent that you need to take that money. So for that reason, the bank is going to charge a higher rate. of 12%, okay? But you can like work not only with the money from the bank, but you can work with the money, for example, of the suppliers. Yes. You begin paying the suppliers immediately. Yes, the suppliers deliver the raw material and you are going to pay immediately for that raw material. But you can begin to pay later. Yes, you can move that immediate payment. For example, maximum you can pay like 90 days later. Yes, so when you are paying later, what is going to be the trade-off? That the supplier is going to charge you a higher price for raw materials. Yes? How can you guys calculate how much is going to be increased your raw material? You are, for example, if you are going to increase 30 days, you are going to pay the supplier 30 days later. You divide 30 days by 600. Yes, this is like a constant number that you guys are going to use every time that you need to make this calculation. So this means 5%. If I increase in 30 days the payment to my supplier, he is going to charge me an extra cost of 5%. Okay, so you can take decision related with those two impacts. And finally, here in this slide, what I want to show you is that there's one financial statement that is going to be validated at the end of the decision. This is the forecast cash position. Okay, and your forecast must be positive. Yes, you cannot make one forecast knowing that my cash flow is going to be negative. No, this is not possible. That I understand that I'm going to have a shortage of money during the next period. No? So every time I need to make my forecast with positive cash position. Okay, if I am giving a negative number, I need to try to do something in order to put back this number positive. Okay, but my forecast can be positive. But probably if I am not going to give all the sales that I am going to expect to do it, probably my forecast is going to be negative. Okay, so at that point the simulation is going to cut some investments. Yes, the first investment that the simulator is going to cut is the one that is related to increase the facilities. Yes? So if I am going to have a cash position of minus $200 and I have invested in facilities for 500, so the simulator is going to cut those 200 and I am going only to increase my facility in 300. Okay, so this is like the general idea of the simulation. I know that's too much information. Once we are going to do go into the interface, and once we do the first round, like most of the questions are going to be like solved. Okay.